Good morning, my dear friends and my students, as well as JABCIB aspirants and banking aspirants. So we have discussed bond market on the last video, right? So today we are going to discuss about a bond yield and bond theorem. It is very important concept. That is the one reason which I have not discussed on the last video, because I wanted to do a full video about bond theorem and bond yield. Okay. So when I talk about yield, right? Yield is nothing but the return generated by the particular fixed income instrument. Okay. The fixed income instrument. Why we call it as a fixed income instrument? Because every bond has got a coupon. Coupon means a fixed rate of interest paid on the face value of a bond. Please remember, coupon is nothing but a fixed rate of interest paid on the face value of a bond or face value of a fixed income instrument. Face value is nothing but starting value or initial value, anything you call it as. It may be 10 rupees, it may be 100 rupees, it may be 1000 rupees, it may be 5000 rupees bonds are there, it may be 10,000 rupees face value bonds are there. If I say the coupon is 10%, that means as an investor, you will get 10% on the face value. Assuming that face value is 1000, you will get 10% on 1000 rupees on every year. That means you are guaranteed 100 rupees on every year. That is the reason it is called fixed income instrument. The reason why we are calling fixed income instrument is your earning is fixed in terms of a coupon as concern, right? If somebody is buying a bond on issue, that means when the bond is issued, you will get it on the face value. That means your income or the coupon is paid on the face value. On maturity, you will get back your face value. That means every year you will get the coupon on face value till the maturity, right? Suppose you are buying a bond on the issuance and hold till maturity, then there is no interest rate risk, but there is a default risk which is there. I already told you, interest rate risk means the bond value fluctuates based on the interest rate prevailing in the market. Default risk, it is based on the issuer, right? If the issuer defaults, then you don't have any other alternatives. But interest rate risk can be managed by buying a bond at face value, holding the bond till maturity. Your interest risk can be mitigated. Okay, right. Now coming back to the yield. Yield is nothing but a return or the return generated by the bond on a particular day. It is called current yield. Current yield. Current yield is nothing but your interest earned by way of coupon divided by current market price. Okay. For example, you are not buying a bond at face value. You are buying at current market price. Please remember, face value and current market prices both are two different terminology. Face value as an initial value fixed by the issuer. Current market price is nothing but the price which is quoted on the bond market as on today. Okay. Current market price, suppose it is 1200. Your face value is 1000. You are earning a coupon of 10% on 1000. That means you earn 100 rupees on 1200, not on 100 rupees on 1000 if you are buying a bond at 1200, right? So current yield, which defines the yield which you earned on current market price. Okay, what is mean by yield to maturity? There is another term which is associated with the bond market. Yield to maturity is the yield which you are earned till maturity, right? Suppose if you are holding the bond till maturity, it is called yield to maturity. Okay, so the current yield and YTM, we call it as YTM. What is YTM? Yield to maturity. Both are two important terms to understand the debt instrument or a fixed income instrument or a bond, whichever you call it as. Okay, let's go to the bond theorem. Last video itself, I explained the bond value or bond price is inversely proportional to yield or inversely proportional to interest rate movement. If the interest rate or yield goes up, bond value comes down. Okay, if the interest rate goes up, bond value comes down. If the interest rate goes down, bond value goes up, right? Suppose if the RBI increases the interest rate, what will happen to the bond market or an income fund which is invested in the bonds? The bond value comes down. If RBI reduces the interest rate, so the bond value or the income fund which goes up. This all inversely proportional. Yield and price, both are inversely proportional. Okay, one should remember this bond theorem concept clearly to evaluate the bond, right? Whether to invest in the bond market or not, right? If the interest rate scenario is continuously going down or you are expected to go down, you can invest in the bond market, right? If you feel that interest rate is going to go up or hardening, then you need to move out of bond market. The bond theorem play a vital role to evaluate the bond whether to invest now or not. Okay, so I will repeat. Bond theorem talks about the relationship between bond yield and bond price. Both are inversely proportional. When I talk about yield, you need to talk about yield to maturity. We call it as YTM. There was another term, coupon. Coupon is nothing to do with the yield. Coupon is a fixed rate of interest paid on the face value of a bond. Okay, so bond theorem, which is talks about the relationship between yield of the bond and price of the bond, right? If once you understand these concepts, then you can easily identify which bonds to invest in the market. Okay, so thank you so much, and we will catch you up on the next video. Wish you all the best for the your examinations and future endeavors, right? Those who are not subscribed our channel, please subscribe it, right? And any of your doubt, please mention in your comment section. Thank you so much.